Hello, dear traders. In this video, I'd like to give you some pro trader therapy. After all, we get so busy with our everyday lives. So ask yourself, how often do you think about your actions and reactions? Did you know that some of our actions are habits and that there are good habits but also bad habits? The good thing is that we can always work on our habits to improve our lives and our atmosphere. And so today I'm going to tell you about a few positive and negative bias that people can have and how it can affect our trading. Don't forget to subscribe, thumbs up, and ring on the notifications bell. My name is Angie. Let's get started. We'll start with the bad habits. Hindsight. Hindsight bias is a phenomenon where people deep down believe that they can predict an outcome of something before it happened. As an example, let's say that you think that Euro US dollar is going to rise, although there are no clear indications or signals. And you don't enter a buy trade, and then Euro US dollar starts rising, and you say to yourself, "Well, I just knew that was going to happen." You see, this kind of thinking can cause overconfidence. And so the next time that you see a similar situation on the market, you may enter a trade incorrectly without analyzing the current situation and newfound facts. And therefore, in order to avoid this mistake, make sure to analyze each situation and trade separately. Focus on market analysis and facts rather than intuition. Next in line, we have status quo. The status quo bias is an emotional bias where traders tend to follow the previous opinion without considering the changed situation. They have a hard time accepting different and new information that can influence the direction of the price movement. This can also lead to an emotional attachment to a trade. For example, you enter a long position, a buy trade, and you believe that the price will grow substantially. But let's say an unexpected report comes out and the asset starts tumbling. Well, it would be hard for a trader to accept these new factors and exit the trade because they are emotionally attached and believe in their previous opinion and previous facts. We have to understand that the world is always evolving and the financial market changes with it. We have to be ready to adapt to new environments and analyze as well as accept changes that come along the way. Be ready to get out of your comfort zone and try new things. Conservatism bias. People that lean towards the conservatism bias prefer original and pre existing information over new data, kind of like with the status quo. And so they have a tendency to follow events that are proved by history. They rely on things that happened previously and dismiss newfound information. My friends, this can cause a trader to disregard new information or react slowly to it, and this can ultimately lead to losses because of improper market analysis. And this can also cause a trader to miss out on profitable opportunities. My friends, I've mentioned this before and I will say it again. The world is always changing and evolving, and the financial market keeps up with changes. There are so many new innovations and creations, and as traders, we have to be ready and open minded to these new findings in order to succeed in this rapid changing world and the financial market. Illusion of control bias. People with this bias tend to believe that they have control and can influence the outcome of events. This can be particularly harmful in trading. It can cause a trader to lose focus because they believe that with deep concentration, they can have an effect on the outcome of the trade, and therefore don't pay attention to facts and information for proper analysis. The illusion of control bias can make us make wrong decisions by entering trades more on chance rather than proper market analysis. And what's even worse is that if the outcome is not as planned, as the trader planned, the trader can start questioning themselves what they did wrong instead of accepting the turn of events as a mistake. Dear traders, always remember that we always have to analyze the financial market and different assets with facts. Now, let's talk about some of the good habits. Let's start with the chameleon approach. A chameleon is a really amazing creature that can change its color according to the item that they touch. They can change to a beautiful, beautiful bright blue and then immediately change to a vibrant red. And they are always ready to adapt to new changes and new surroundings. This is a great trait in trading because it can help with quick thinking and quick decision making. Next in line, we have the white soul approach. The white soul approach is the ability to keep to your principles of investing. When I think of the white soul approach, I think about snowshoes, the ones that look like tennis rackets. You see, when people wear these big, wide snowshoes, they have a very good leverage and can easily step through untouched territories of fresh snow without falling through. And just the same way, the white soul approach helps us keep our footing when trading without tripping and falling when new information arises or during emotional uncertainty. The white soul approach helps us to keep calm, to keep track of new information, and helps us always analyze the financial markets so that we're armed with information and facts to enter the market with confidence. Next, I have the archer approach. Approaching trading like an archer. Be confident that the arrow will hit the target. Actually, position traders are more like investors that trade for the long term are actually sometimes called archers or snipers as well. So, when you are making your forecast, imagine that this could potentially be the most successful and profitable trade of your life. This will help you focus and correctly weigh the pros and cons. There are no coincidences in a successful trader's portfolio. Each trade is thought through and planned out as if it was the last in a lifetime. And so, with thorough market analysis and proper planning, following money management and risk management, you can enter the market with confidence and trade like a pro. Trade like an archer that's ready to hit the bullseye. And now, let me tell you about an interesting framing effect that can go both ways. Here's an example how the framing effect works. Listen closely. Let's consider two scenarios. Let's say that you invest $1,000 and while you are trading, you earn a profit of $500. But then one trade goes wrong due to unexpected and high volatility and you lose 200 of your hard-earned profit. The second scenario is the same. You invest $1,000 and while you are trading, you earn a profit of $500. Then there's unexpected high volatility and the market turns against you, but you are able to keep 300 of your hard-earned profit. So this is basically the same thing, but one is more positive and one is more negative. So it really all depends on how we perceive things. In trading, it often happens that if you lean more towards the positive framing effect, a trader may risk less and miss out on profitable opportunities, versus a negative framing effect may cause a trader to risk more and make hasty decisions, which may lead to losses. To avoid this psychological mistake, think outside the box. Analyze each situation separately and try to look at the situation from different sides, envisioning different scenarios and outcomes. And so, my friends, keep these habits in mind and pay attention to your actions and reactions during different situations. And if you notice a bad habit, work on it. You got this. I hope that you enjoyed this lesson. And we have a lot more interesting content on our channel. So please make sure that you are subscribed. Give this video a thumbs up and ring on the notifications bell. Likewise, my friends, check out the action on our social networks. My name is Angie. Thanks so much for tuning in, and I will see you guys next time. Bye bye.